Okay, let's get started. Good afternoon and welcome to today's webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play, and today we will be doing an educational webinar on trading earnings, especially because we're in the middle of earnings season. There was quite a lot of interest by you guys for an earnings type webinar. So I thought that, instead of going through a different strategy for today's webinar, we'd go through earnings and how or what my process is before entering an earnings trade. So a big thank you to those of you that did provide the feedback for looking into earnings for this webinar. I think it's a very interesting topic. And yeah, it's my first time really speaking on earnings as an educational topic. So very excited to get started with that and to share, my thoughts and really Options Play's best practices as well when it comes to trading earnings. So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. All examples are for illustration purposes only, and examples do not include any commissions or fees. So our agenda for today, we're going to do a quick Q2 earnings review, I should say. That should not be preview, that should be review. We're in Q3 earnings right now, but the first step when it comes to trading earnings is to understand what happened in the previous earnings cycle. From there, we'll take a look at what are the fundamentals we tend to look at when it comes to earnings. We'll also take a look at calculating the implied move using a straddle for earnings. A very important step, one of the more initial steps for doing an earnings trade, but in my opinion, very important because once you understand how to calculate that implied move using a straddle, you can start looking at the optimal strategy that you may want to deploy for your directional view. That could either be a straddle, it could be a debit spread, it could be a credit spread as well. And of course, we'll go through the examples as we go along with this webinar. So the main question I want to help answer for you today is how can I trade earnings season with confidence and maximize returns using options? So quite a loaded question. Trading earnings is, in my opinion, can be a bit of a gamble. Ultimately, it's a high volatility event where you have little to no control of what's going to happen. The stock can make a big move to the upside or the downside, or even stay fairly neutral. But either way, it is one of those high volatility events where price jumps very quickly in a short space of time, meaning that you also have very little time to manage your trade or mitigate risks. So, the most important thing about earnings is really understanding what are the risks associated with it. Yes, it's all great when earnings work in your favor, but when it doesn't, that's when an assignment can happen very quickly. That's when you can lose a big amount, again, in a very short space of time. And because it's such a short space of time, trade management somewhat goes out of the window. You can't really manage a trade during that earnings announcement. So that's why I want to really show today, my best practices with earnings, like how to essentially establish a trade with those best practices deployed beforehand, as opposed to trying to do damage control if the earnings play goes against you. And a lot of the times, before I continue, I just want to say a lot of the times when it comes to earnings is that you can't do too much damage control after the move goes against you. So it's all, again, I'm going to emphasize this throughout the webinar that it is always important to understand the risks of your strategy when trading earnings. It is a high risk thing to do. I would never suggest only using an earning strategy as your entire trading strategy. It's just one of those things where if you think that there's a good opportunity, it's something to take advantage of, but it's not something that you want to be too dependent on with regards your trading strategy. And also, when it comes to trading earnings, this is definitely for more advanced traders. It's not for beginner traders. When it comes to beginner traders, the first thing I would say with anything to do with earnings is you want to avoid earnings. You want to avoid high impact volatility events where you have no time to manage. Only for advanced traders who understand the risks beforehand. This is where, trading earnings and understanding some concepts of earnings can make a big difference. So to do a quick Q2 earnings review, so there was a few points to be made from the last earnings cycle. The last earnings cycle came off towards the end of essentially a summer rally. We saw equities in general rally towards the year end. Towards the end of the summer, largely due to the AI boom, and there was a good bit of optimism. However, the analyst expectations were a bit less optimistic. So there was a broad-based decline averaging 5.4% for EPS year on year, but still performed better than the 7.1 decline that was expected by analysts. So slightly better in terms of EPS, but all in all, it's still an EPS contraction compared to Q2 2022. Revenue increased by 0.6% year on year. However, we only expected 0.4%. So again, generally speaking, another positive in terms of revenue compared to analyst expectations, but still not a huge amount when you look at the grand scheme of things, not a huge amount of revenue growth. And we have to also keep in mind the macro picture when looking at earnings or looking at an upcoming earnings season. We know that right now interest rates are a lot higher than they were a year ago, and that is going to have a negative impact on EPS and especially revenue, as consumers, generally speaking, will have a lot less spending power. Margins declined to 11.1% year on year compared to the 11.6% expected by analysts. A couple of other facts that we saw: 86% of technology and discretionary companies beat earnings in the S&P 500. So that's a pretty significant number. And 57% of utility companies missed earnings. Also, beats were down 0.1% and misses were down by 2%. So what does this mean? And this is a pretty important concept to understand. So usually the two big numbers when it comes to an earnings announcement are EPS and revenue. Analysts have expectations for every company for the EPS and the revenue numbers that come out. And a lot of the time, I'm sure many of you have noticed, especially those that have traded earnings in the past, is you tend to see revenue and EPS sometimes beat those expectations, but the stock can still decline. This has to do with the forward guidance that comes out with an earnings announcement. The forward guidance by the company may be a bit more on the negative side. And because equities are forward-looking, they're going to start pricing that in already. So even though we tend to see sometimes an EPS and a revenue beat, we could still see the stock decline. And that is what we saw, on average, a 0.1% decline on the stock, despite the fact that that company beat earnings expectations. When the company missed the earnings expectations, so revenue and or EPS was below expectations, we saw the company stock decline by average by 2%. So that's the 2% is pretty much expected, for a decline or for a miss, but the 0.1% decline despite a beat, that's more surprising. And we are seeing maybe a bit more of that right now. Maybe not immediately, but I'm sure you've noticed that there's some companies, and we're going to go through an example of JP Morgan, which is a great example for this, where you see the company beat in terms of earnings and revenue, but still decline over the next week. And we have to remember that even though a company could do well in isolation, it still has systemic risk because of it's part of the broader market. And because of that, we tend to see the company or that specific stock essentially conform back into where markets are heading. So if we're in a bearish market, even if we do get an initial beat, we could see the stock jump up higher and then eventually decline. Or if we're in a bullish market and if we get a miss, we could see the stock decline immediately and then continue higher. So it's always important to incorporate your macro view into your earnings trade and your earnings setup, just so you can manage expectations and analyze what to do if there is a beat. Okay, if there's a beat, but if we're in a bearish market, it will be a good time to be taking profits if the stock immediately rallies, and vice versa. So before we take a look at that JP Morgan example, which I'm quite excited to show you actually, because this is a trade that I specifically did, and it was a very interesting one. I quickly want to go over the fundamentals. So when it comes to fundamentals, there's a lot of numbers when it comes to looking at ratios, looking at financial statements, and it can be quite tedious or tiresome when trying to understand the fundamentals and trying to look at every single one of these numbers. And in my opinion, you really don't need to do that. So what I do is essentially incorporate what I'd call a sniff test. All right, a sniff test is a very quick way to just gauge the overall health of a company before entering an earnings trade. So we have Apple earnings coming out tomorrow. There'll be a big, largely awaited earnings announcement. And if I were to look into Apple earnings, yes, there's a lot of information available in terms of ratios, but sometimes you just want to keep things incredibly simplistic. The first thing you need to understand how the company generates their income, and you want to preference, obviously, the profitable companies within that industry or within that subsector. But basically, having a clear understanding as to what are the revenue drivers for that company is very important, because once you understand how the company generates income, you can essentially do a top-down approach. You can look at that entire subsector or the industry and see where those trends may be occurring. So like, let's say, for example, phone sales are down across the board, and the iPhone sales make up a huge chunk of Apple's revenue, you may want to have a more pessimistic view on Apple's revenue numbers and EPS numbers. So this is more of there isn't a hard set rule in terms of what to do, but having a bit of a top-down approach and understanding the revenue drivers of the company is always beneficial. Now, like I said, lots of percentages, lots of ratios, but the most important, or the two most important ratios that I'm looking at, or numbers that I'm looking at, is the valuation, or it depends on which type of company, but you are looking at valuation metrics, and you also are looking at EPS growth or even revenue growth, but mostly EPS growth. So valuation tells us how much a company is worth, essentially, and it's a great way to compare that company to different other companies, because it tells us, okay, how expensive is the stock really for how much this company is worth. Now, what we saw during the pandemic recovery period were crazy high valuations, because people had a lot of money that they were throwing into the stock market, and those valuations continued to rise. So, like, for example, we had, tech companies with price to earnings ratios, for example, well over 100, well over 200, and those would be considered heavily overvalued. However, it was during a time where interest rates were very low, and now that interest rates are rising, we know that those companies have gotten punished and they've declined. Those valuations have come down as well. So when it comes to an earnings trade, you want to look for a name that has low valuations or low valuation. You can use price to sales. I prefer price to earnings pretty much across the board. If you're looking at a bank name, you may want to look for the price to book ratio instead. And then once you find a company within your sector or within a specific subsector or industry that you like, that you understand how it generates profits, and that you can see has a lower than average valuation relative to peers, that's when you want to start looking at the EPS growth. So what is a projected, or what was a past EPS growth for that company, and what's the projected EPS growth for that company? And again, you want to compare it to its peers. So I'm sure you may notice that I'm not saying any specific numbers, because there isn't a golden specific number that indicates good or bad EPS growth. But you have to compare it relative to its peers, because that gives you the best in class companies in the industry, and those are the ones that you want to have bullish earnings trades on. And for the bearish earnings trades, you want to look for those weak companies that maybe that have very high valuations, or maybe that have very low EPS growth and revenue growth, and low projected EPS and revenue growth, because those companies, even if their earnings is a little bit off, they tend to be punished by a larger amount. For a company to have a high valuation, it needs to have an incredibly high revenue growth to justify that valuation. And like I said, even if you see a small miss on the revenue side, those highly valued companies, they tend to be punished to the downside quite dramatically. So focus more on the valuations and EPS growth, as well as revenue growth, but I still prefer EPS growth in that regard. Generally speaking, you want to have positive revenue growth over the last trailing 12 months, just general rule of thumb. So that's how really simple we can make the fundamental analysis. We just have to take a simple sniff test in terms of, okay, is this company in a healthy place? Is a subsector in a healthy place? And how does it compare to its peers? Is it performing better? Is it performing worse? And First Trade actually have a very nice widget, if you will, where it tells us, where the average is, and that shows our performance when it comes to the revenue, 3-year revenue growth for Apple. We can see that it's outperforming. When it comes to net income 3-year growth, we can see that it's outperforming. And overall, these numbers look pretty good, right? So that's the general idea of the sniff test. You don't have to be too specific in the numbers that you look at, but you just want to get an overall understanding as to whether this is a good company relative to peers or a bad company relative to peers, and keep it as simple for yourself as you possibly can. Now, after the fundamental analysis that I incorporate, the next thing I would look at is relative performance. And this is a very important one. This is more of a technical way of looking at, a technical analysis way of looking at an earnings play. So relative performance indicates or compares the performance of the company or the stock relative to the subsector or the sector that it's in. So you can compare. For this example, we used JP Morgan. JP Morgan had its earnings a couple of weeks ago at the start of earnings season, like all the major banks do. And what we saw during this earnings announcement, as you can see, this is where the earnings announcement happened. What we saw with JP Morgan was first some bullish price action heading into that earnings announcement. That's the first thing you want to look at. You want to see, okay, how is the stock behaving a few days ahead of earnings? Because we know markets are going to be focused on earnings for the specific stock, and we want to see if there is accumulation in this case. In this case there was. We did see a bit of a rally heading into that earnings announcement. Earnings came out, EPS good, revenue good, especially with in a high interest rate environment. Banks tend to do quite well. And because of that, we saw an immediate jump up higher in price, kind of rallying to around that 153 area. So this, for a bullish play, JP Morgan actually worked out really well. I'm not trying to refer to the days after that. For now, we'll get to that. But for now, we can see right after earnings, it was a good bullish earnings play. But you also want to look at the relative performance heading into earnings. So again, this is when the earnings announcement happened. And as you can see, the relative performance for JP Morgan against XLF, which is the financial sector, has been very strong heading into earnings. There's been a good bit of accumulation. It tells us that investors are rotating out of other banks or other financial stocks and into JP Morgan. Very simplistic way of saying it, but that is the case, that JP Morgan is outperforming its financial sector heading into earnings. And that's what you also want to see heading into that earnings announcement. So earnings came out, we got an earnings beat, and we saw that initial jump up higher in price. So overall, if you went for a bullish strategy here for JP Morgan, with the fundamentals aligned to your bullish view, if it passed a sniff test, for example, this would have been a great earnings play. But what happened shortly after, and this is why I say this is a great example of a nice earnings play is what happens right after is that JP Morgan started to decline and started to decline just like the broader markets. So what does this tell us? Well, psychologically, it tells us that the numbers were good. We saw an initial move higher, but JP Morgan is not immune to the systemic risk of markets. And because we are seeing a broad-based decline in markets, JP Morgan has declined along with the market. It can also tell us that, yes, the numbers were good. It provided an initial strong positive reaction, but the numbers weren't good enough to keep that level sustained, which is why we have also seen a decline, and also a decline in terms of relative performance against the broader market. So this can very much happen. And in this case, if you are going to enter a bullish earnings trade in a bearish market, you normally want to get out of the trade sooner rather than later, because eventually, or in this case, very soon, the stock will once again start correlating with the market, which in this case was quite bearish. And it works the other way as well. If you're looking for a bearish play in a bullish market, you want to get out of the trade quite soon. Now, if we were currently in a bullish market, in that case, sometimes it may make sense to actually hold on to half of your position. It really depends on the strategy that you use, but it may make sense to actually hold on to the position and really take advantage of a continuation in this rally. But in this case, it did not make sense. So even though the earnings was a positive outcome, we have seen the stock decline. And that is why relative performance is so important. It gives us a nice snapshot of what the markets are thinking ahead of that earnings announcement. So now, once you've done your fundamental analysis, once you've looked at the relative performance and maybe looked at some technicals, another thing that I actually forgot to mention in the previous slide was technicals can be important where if you see a stock at an area of support, normally that provides a good risk to reward bullish entry point. So it adds another confluence in terms of, okay, this would be a good bullish earnings trade. Normally, you don't want to enter a bullish trade when the stock has rallied very significantly, but rallied to, like, let's say, an overbought condition where there's a high probability of reversal down. You don't want to bet on a bullish earnings announcement where it would even reach further into that overbought territory. So normally you want to see good relative performance and still near an area of support, or where it's not in an overbought condition. So there is a bit of a sweet spot there. Sometimes too good relative performance can not be a good thing because it doesn't provide a good risk to reward entry point. Now, after you've done all of that, calculating the implied move is the next step. And it's a very important step. The implied move tells us what the markets think the stock, or how much the markets think the stock will move over a certain time period. So to calculate the implied move, we can use options to do that. And I'm sure some of you have heard of this option strategy called a straddle. So a straddle simply involves, in this case, we'd have to use something called an at-the-money straddle. And a straddle simply involves buying a 50 delta, or roughly 50 delta call, and buying a 50 delta, or roughly 50 delta put. Basically, you want to buy the most at-the-money option you can on the call side, as well on the put side. And you also, when it comes to targeting the expiration, you want to look for the closest expiration right after that earnings announcement. So it tells us, let's say, for example, we buy a straddle for the November 3rd at the money 170 straddle, and we're paying $700 for it, or $7 per share. This tells us that the market by November 3rd is expecting Apple to either rally by 7 towards 177 or decline by 7 towards 163. It's quite simple. I know this may initially seem a little bit complicated, but the straddle is simply buying a call and a put, and it tells us the cost of that call and the put combined tell us how much the market is implying that move. And then from there, we can actually decide what strategy to use, because you may think that, okay, the market is only implying a $7 move for Apple, which has earnings tomorrow. but I think it could be a $15 move or a $20 move. Or you could say, I think that move could be mitigated below 7 and could be maybe a $2 or $3 move in either direction. That once you start to formulate a plan or where you think price could potentially head to, you can use a specific strategy to make the most out of that. Okay, so the first strategy, the first out of the 3 strategies that I'm going to show you is the straddle. And in this case, you're buying an at the money straddle. I know in a previous example, to calculate the implied move, you're using a very short dated straddle because you want to target the expiration date right after that earnings announcement. However, when it comes to actually the trade itself, you want to buy an at the money straddle. My screenshots were a little bit messed up here, so don't worry about this expiration. It should be around 60 days to expiration. But we'll say, for example, that this is like the December monthly expiration instead. So we buy an at the money straddle, usually around 60 days to expiration. The strike prices naturally would be at around 50 delta. And very important, you only want to use the strategy when you expect a move larger than the cost of the straddle. Now, this strategy does profit from any direction. So as long as the magnitude of the move is higher than the cost of the straddle, you will be profitable in a very simplistic way. So you're expecting a big move, but you don't know which direction. That's when you look for a straddle. Now, when it comes to the strategy, I never really use it. And the reason for that is because there's no directional view. And by trying to gain a multi-directional view, as in by buying a call and a put, you're buying 2 options, and that is going to essentially increase the maximum risk of this trade, right? You instead of buying, if I only had a bullish view, I buy a call, I'm risking a lot less than buying a put, than buying a call and a put option. So that combination of these 2 options increases the cost of the straddle or the cost of your trade, and therefore increases your maximum risk as well. So this strategy, it is a very simple strategy to use for an earnings season, but again, it does expect a large move in your favor. Sorry, 1 second here. My computer's just being weird. Okay, apologies for that. But yeah, so the straddle strategy, a very simplistic strategy, but not one that I'd highly recommend. It is one that is used during earnings season quite a lot. But again, there are better strategies in my opinion, especially if you have a directional view. Okay, so the second strategy that I'm going to go for here is to buy a debit spread. This is when you expect a strong directional move in one direction or the other. Now, unlike a straddle, straddle that gained profitability on a big directional move in either direction, a debit spread would only gain profitability in one direction. So let's say we've done our research on Apple, and we have a bullish view heading into tomorrow's earnings announcement. What we would do is look for a target expiration date roughly 60 days from now, and we would buy a slightly out of the money call or put, and in this case, because we're bullish, we would only buy a call and sell a bit more of an out of the money call as well. So the reason we go for a slightly out of the money call is because leading up to an earnings announcement or a high implied volatility event, or a high volatility event, I should say, apologies, options can be very expensive. And remember, we are buying an option in this case. So because of that, the at the money option can be quite pricey, but at the same time, we still are expecting a big move. So we can't afford to go for a slightly out of the money, in this case, a 40 delta. So in this case, it will be maybe the 175 strike. Again, I got my screenshot a bit messed up here, but assume this is like the 175 and 195 call vertical, not the 170, 190. So we go for the 175 strike to buy. slightly out of the money, so the stock has to rally a little bit more to reach that strike. But we also sell a more out of the money call option as well, 16 delta, and that reduces the cost of buying the more expensive 40 delta option. So like in the straddle example previously, we were buying two options and that essentially doubled our maximum risk. Whereas in this case, we're foregoing the gaining bearish exposure. We only want to focus on bullish exposure, but we can reduce our risk by only buying one option and selling another option to reduce the cost basis of the more expensive option, a call that we are long on. So, debit spread, again, still a fairly basic strategy, but a much more effective strategy when you have a directional view, and you have a directional view where you think the stock will move by a large magnitude. Now, when it comes to the cost of the debit spread, you're usually looking for anywhere between 25% to 30% of the vertical width. So let's say, for example, let's say we're going for the 170, 190. This costs around $8 per share, or 800 in total. Now, the vertical width here is $20 between 170 and 190. And because this is $8, this is a lot more than 25%. So this specific debit spread won't work. But remember, this was at the money debit spread. If we go slightly out of the money, the cost of it would be cheaper. And let's say, for example, the cost was closer to $5 to open this vertical spread, which is 25% of the vertical width. Therefore, in that case, it would be a good debit spread to go for. But usually, you don't want to exceed that 30% threshold on the vertical width, because otherwise it indicates that the option or the strategy is just a little bit too expensive. Okay, so the last strategy that I wanted to go over today was the credit spread. Now, this is my favorite strategy. And this has to, the reason it's my favorite is because there's a few more things working in your favor and you get a bit of a buffer. So a credit spread, this is when you expect a moderate directional view. So you don't have the markets are implying a $10 move in either direction or a $7 move in either direction, depending on the straddle. But you only expect maybe $3 move in either direction. A credit spread is a much better strategy to use in that case than a debit spread, because there's this move of a small magnitude. So the expiration date that you want to target would still be 45 days to expiration. So we're still using our best practices for debit spreads and credit spreads. A slight change for the debit spread by going for the 40 delta, but for credit spread, we're still using our best practice of selling the at the money 50 delta. This could be a call or a put, because if you're bullish, it's a put. If you're bearish, it's a call. And then you're buying an out of the money 25 delta put option if you're bullish, again bearish if it's a call option. And because in this case we're bullish on Apple's earnings, we are selling a put vertical. So we're selling the 170 strike put vertical and we're buying the 160 strike put vertical. This generates a net premium, which is an income received immediately, and it also represents your maximum profit for the trade, which in this case is 300 in total, or around $3 per share. And the general rule of thumb, like the debit vertical spread, but for the credit vertical spread, you want to collect at least 1/3 of the vertical width. So in this case, $3 per share over a $10 wide vertical is just under 33%. It's around it's about 30.707%, 30.7%, I should say. And it's a little bit below our threshold, but usually, you're going to go plus minus a few percent either way if you still have that directional view. So, 30%, I would still say is okay, but you generally want to have 33%, be collecting 33% of the vertical width when selling a credit spread. Now, the reason like I said before, you want to sell a credit spread is when you expect a moderate directional view. But the one thing that I haven't spoken about so far in today's webinar is a concept of implied volatility. So implied volatility, it plays an important part of the options pricing formula. And like I said earlier, when we have a high impact event or a big news event or earnings, implied volatility is high because markets are expecting a big move. And what happens after that news event is that even if the stock stays at exactly the same price, if in this case Apple stayed exactly at 170, the value of the options will decline rapidly because of the fact we experience something that's known as a volatility or an implied volatility crush. Because now the markets don't expect a big move anymore. That event has already passed. Apple hasn't moved. We experience an implied volatility crush, and the options on Apple would all of a sudden become a whole lot cheaper, as there's very little implied volatility left. So that is a good thing when it comes to credit vertical spreads, or whenever you're selling an option. It's a bad thing for a strategy like this, where you're essentially buying an option. Remember, this is a net debit for debit spread. You're receiving a net credit. Your goal is to sell high and to buy to close it at a lower price. And implied volatility crush is a great way of getting that price lower, even without a directional move in your favor. The second reason I do like credit spread is because of the fact that time decay works in your favor. So let's say, if we use a debit spread and we got a big move in our favor, the debit spread will be profitable, but that profit will depreciate because of time decay. Whereas for a credit spread, we want it to depreciate. We want the value of the options to depreciate, so we can buy to close it for a lower price, or even let it expire worthless and keep our full premium that we collected initially of 300. So that's why I prefer credit spreads over debit spreads for strategies, for earnings, because it just allows us to keep in the trade for a little bit longer. But if you are expecting a big move or a very big move from an earnings announcement, you'd much rather go for debit spreads. Credit spreads are more forgiving, but they offer a lower max reward. Debit spreads, less forgiving, but they offer a higher max reward. One isn't necessarily better than the other. It solely comes down to your directional view, and of course, how big of a move in terms of magnitude you're expecting. So with that, I'm going to open the floor to any questions that you may have. Please use the Q&A window. Thank you. So where do you get that info on First Trade for the fundamentals? Okay, so I'm going to show you here very quickly. I just got logged out from First Trade. Let me just log back in very quickly. So if you simply type the ticker onto search bar. Apologies for this. My computer it's not working great today. But if you simply type the ticker, click on search, and you'd be in the research and tools section. And from there, you can take a look at the key ratios, even some of the summary. There's a lot to read here, which is great. But and this is perfect for sniff tests. I like using First Trade for sniff tests because it just summarizes the info very nicely. How long does it take for an IV crush to happen? Also, do these strategies apply to Fed meetings on ETF and index options? Yes, they do. I think Fed meetings maybe a little bit less so, but there is definitely a volatility crush because the Fed meeting is a high impact volatility event, and markets will be pricing that in. Markets are pricing that in today, right, with the Fed meeting or the speech that's coming later today. So the Ivy crush happens pretty much immediately, but it's hard to quantify it because there's usually a big move. And because of that big move, the deltas change. And because the deltas change, the value of the strategy changes, or the value of your position changes. But the Ivy crush component does happen immediately. What is the best strategy when we think the stocks move will be lower than expected? That would be the credit spread, because it doesn't require a large move in your favor. A debit spread, on the other hand, and even a straddle, requires a large move in your favor for that position to become profitable. A credit spread is much more forgiving. You actually want a small move, and you want the value of the option to depreciate, so you can buy to close, or you can buy low and generate a net profit. Okay, so if there are no more questions, thank you so much to everyone for joining me on this. So I just see a question from Justin here. Are there any sources of info you'd recommend for researching deeper into this after the sniff test? Definitely Morningstar. Morningstar is a great researching tool for me. You know, I really like looking at Morningstar. It gives a nice competitor analysis as well. But usually, you know, when it comes to key ratios, you can get that from anywhere. But I do tend to use Morningstar, and even First Trade just for a quick snapshot. Can we use calendar spreads to play earnings? Technically, yes, but I would not recommend it, really. I mean, earnings is one of those things where you just want to kind of get in quickly and get out quickly. Yeah, I mean, calendars, you know, there would be volatility crush impacting the short leg, especially because it'll be closer to expiration. But at the same time, no, I'd much rather go for, you know, I think a debit spread or credit spread, keeping it more simple, would just be a much better strategy, because you can get out of that strategy quite easily. Okay, and with that, again, thank you all for joining me. And I hope you all have a great trading week. I will see you next week, Tuesday, for another market outlook. And yeah, I hope you all learned something about the way I look into trading an earnings announcement. You know, the steps that you follow. You have to be somewhat flexible in your approach, but also still keep somewhat of a template. And I hope I conveyed that. So thank you all. And yeah, have a great trading week.